So we have two people up here who you guys have not met yet. Those are Alice Lomax. She is a female, obviously, senior analyst here at the Motley Fool. She manages her own real money portfolio. Alice actually has a very interesting philosophy when it comes to investing. So Alice, could you share with us a little bit about how you invest?
I actually invest, the numbers are important, and I do look at the numbers, but I also have a very qualitative view that includes environmental, social, and governance, and of course, more women involved, and more women on boards of directors and investors, and you can call it socially responsible investing. You can call it conscious capitalism or triple line investing, but it's basically it. It's pretty complex.
And what's a company that you think embodies that socially responsible investing that you look for?
There are quite a few, but one of my very favorite companies is Whole Foods Market.
Yeah, yes, we all like that, don't we? We also have Tom Gardner. He is 50% of the founders of the Motley Fool here, and he is co-founder and CEO of the Motley Fool. So many of you probably recognize his face. Tom, my question for you is, when was the last time you took investing advice from a woman?
Wow, did we get preparation time for this? Well, I think that would probably be Alice to my right, because Alice is one of our finest writers at the Motley Fool, and I think conscious capitalism, which is a part of my closing talk, so I won't go too deep into it, but there's an endless amount to learn about how well an organization treats its stakeholders, not just its shareholders, obviously, not just its customers, not just its employees, also its suppliers, the communities that it operates in. And in fact, Whole Foods and some of the companies in conscious capitalism are beginning to demonstrate that their competitors are stakeholders. Because after all, if you share a purpose statement and a mission with another company, they may actually be allied with you in certain situations, and they may actually be the company you should be partnering most closely with because you're both trying to achieve something great. So I would say that Alice's work has really influenced me and my thinking, and particularly, covering Whole Foods, which is a company that I own and that I love.
And full disclosure about Whole Foods. It's exciting news. It's not bad news, by the way. The co-founder and CEO, John Mackey, just about 3 weeks ago signed the documentation to join our board of directors. So we're very excited about that. Very exciting. As the questions are coming in here, I just have a couple more I can do. Now, Dayana, you saw me here, or you saw her up here with me earlier. Dayana is our personal finance expert here at the Motley Fool, and so my question for you, Dayana, is for the newbies out here. When is someone ready to start investing? When do they need to be? Where do they need to be spiritually, financially, mentally, all those places to take that leap and become an investor?
Well, if investing is on your vision board, no, I'm kidding. Yes, dream catcher. There's some financial housekeeping that you have to have taken care of to set yourself up to become a successful investor. One of the first things is not to have high interest credit card debt or high interest debt, and typically that is credit card debt. So, Maya, do you have credit card debt? No. Okay. Great. Check. The next thing is to have a stash of cash that can help you cover an emergency should one arise. It's the credit card debt avoidance fund. So that is important because you don't want to have to sell stocks to cover an emergency because you're a long-term investor, correct? And you want to hold on to those and give them a chance to run. So, Maya, do you have an emergency fund? No. Dad's going to help out with that. And then next, you probably, if you are working and your employer offers a 401k or any type of retirement plan, you're already an investor as long as you participate in that. So that's great. What you want to do beyond that, because your choices are limited in those plans, they might not be ideal. This is the time when the rubber hits the road and it gets exciting. And as long as you've got your debt under control, you've got some emergency savings, you're already getting any free money through your employer as a match in your retirement account, then it's time to start investing on your own, to set up a discount brokerage account and start buying stocks. And there's nothing better, there's no better education than just, as Rebecca said, buy a stock, follow it, get involved. It's exciting. You've got skin in the game, and you're going to get to know that stock and how the market works and how the industry works. It's a fantastic way to really just dive right in.
Thank you. I'm going to send this next question over to David. So it is, some think that the stock market for 2014 will be as good as 2013. What does the Motley Fool think?
So it's very natural to think that whatever just happened is likely going to continue to happen. Most people are, I think, investing in a rear view mirror, and that's why classically we're making the wrong decisions at the wrong times. After things have been great, we finally want to buy, we finally have courage, and then after everything's been bad, which it is 1 year out of every 3, it's that time that we say, you know what, it's been so bad, I'm just going to stop this right now. My answer about 2014 is that it is completely disconnected from 2013, except that it happens to follow it. I go with kind of straight probabilities for answers like this. 2 years out of every 3, the market goes up in value, and the average gain of the stock market is about 10% per year. Of course, it's never really that average, and there are almost no average years. But I would assume, without making a fool out of you and me, that the market will rise in 2014. I doubt it would be as spectacular as 2013, and I'm fully prepared for the market to drop 25% in 2014 if that's what's happening next. Although I think usually significant drops happen when there's something really bad going on systemically. And I think in general, we're seeing wonderful things happening in business. The IPO market was incredibly strong this year, and a lot of great companies, Twitter most recently, have gone public. So I certainly feel good. I remain fully invested all the way through here. It was true when I was 18, and 48 is what I'll turn this year, so I feel pretty good about the next 30 years as well.
Does anyone else want to chime in on that?
We don't make a lot of market predictions at The Fool. That's really not how we butter our bread.
There's a writer at the Motley Fool who I would encourage you to follow. His name is Morgan Housel. He's a wonderful thinker about business, investing, the economy. He went back and did historical research. And if you go back to, I think, 1820, but if you go back more recently to 1929 or 1925, I think the second study comes from, every 11 months, there is a 10% decline in the stock market on average. And actually, it's pretty evenly distributed. It's not like you have wild outliers, and that's how. Every 11 months, the market falls 10%. So we didn't have a 10% drop last year, and we've had a great couple of years. So for that reason, I made a bet with the members of Motley Fool 1. I don't know if we have any Motley Fool 1 members out in the audience today. Yes, great. Yeah, I see some familiar faces. So my bet is that the market will fall 10% at some point this year. So it may be after a 20% rise, or it may have started on January 2nd. My bet is that if it does not fall 10% or more, I will walk the equivalent of a marathon every day on my treadmill desk for 5 consecutive days. So I'm cheering for a market decline. And part of the reason I did that is I wanted to get all of our members with that mindset. Hey, we want a 10% decline. I mean, if we're at the very end of our investing lives, we don't. But if you're adding income or you've got savings or you've got some cash on the sidelines, which I think is a good idea for many investors to have some cash on the sidelines, then you're excited about that once every 11 months. And I can tell you, obviously, investing in stocks is the best performing vehicle, of all alternatives out there. It's also super liquid compared to real estate. So it doesn't have any maintenance costs, like property tax every year, et cetera, that aren't often factored into the returns of real estate. So investing in stocks is really a wonderful return, straight up, doing as Dave, just buying, just keep adding. But think about the better return you could get if you just knew, hey, every time it falls 10%, I'm going to make sure to have some cash that I can put in at that point in time. That's just going to enhance your returns over time. So I'm cheering for a 10% decline.
Tom wants to
desperately,
go shopping.
Somewhat desperately.
All right, Lou, our next question is for you. So fools are suggesting that a married couple should wisely let the wife manage the portfolio.
Well, I would say I liked what Rebecca said, where she does 50%. At least start asking questions. I mean, these are stories of people I've read about or stories we know. We hear from our community all the time. For instance, a friend of mine, a guy I know in real life, his mom let his dad handle the investing stuff in their house, all the finances for their entire life. And his dad is a career Boston police officer, has worked the night shift for the last 30 years in Boston. And they were just right there, ready to retire, ready to do all those things that they had always wanted to do. And his father was diagnosed with early onset Alzheimer's, which is heartbreaking in every conceivable way. But now his mom is, because she's never been involved in the finances, is playing catch up at the worst possible time. I mean, that's always my advice, is don't be playing catch up at the worst possible time. Life, there will be things that happen. There will be tragedies. There will be things we can't foresee. Don't let those stresses add on to you trying to figure out, hey, holy cow, where is the password for that account? Or what are we invested in? I have no idea. Things like that just absolutely break my heart. Start today, start figuring this stuff out, start asking. Even, let's say, hey, it's okay. You don't want to be the next Warren Buffett? No big deal. At least sit down with your partner, your husband, whoever, and start asking those questions. Get involved. I do think the research shows that the feminine influence on the male in those investing decisions in your partnership and in your household and in your life are very positive. They're very calming. But I'm not sitting here and trying to tell everyone, hey, you have to be all the time, every day, analyzing stocks. But I do think you need to be asking these questions and getting involved and start. Don't wait. Just start now. That would be my advice.
Now, Diana, you wrote the Motley Fool's book on couples and cash. What, so this is a question for me, sorry, but I'm asking it.
Ron is not always right.
What is?
Your husband is not always
Right, you're telling me. What do you see as kind of the common pitfall that couples fall into with money, and how do they avoid that?
What Lou was saying, that even if you're not taking over the finance, even if somebody is doing most of the heavy lifting, be it balancing the checkbook or letting online do it that way, or investing, that the other partner must absolutely know what's going on. You should have, companies are fond of quarterly meetings to keep their shareholders in the loop. That's a great idea for couples. So invite your husband to sit down and see what you've been doing. Make sure that he understands why these investment decisions have been made, why these purchasing or debt decisions have been made. Give him an open forum to ask questions as well. But the biggest pitfall is exactly what you said: not knowing, not being involved, not knowing what's happening with your family finances. Because if you've intermingled finances, it's truly family finances. The other big one is credit, is related to credit, and there's a generation. It's usually my parents' generation, where a credit card or credit was opened in my dad's name, for example, and maybe my mom was added as a joint account holder, not necessarily in her name, not as a co is it the same way. If someone passes away, suddenly that line of credit just gets cut off, and at the worst possible moment. So have credit in your own name, separate from your spouse or significant other. It helps avoid a lot of heartache in the long term.
Alice, I've got one for you here. Even long-term investors must at some times sell a stock. What are some basic decisions that you put behind selling a stock?
Generally speaking, I'm one of the people that we have discussed that really would prefer not to sell unless it's a serious, serious problem. If a management seems to suddenly strike me as not a good management, or if there's just a serious problem with what's going on with the company. But really, I prefer just not to, and to just kind of mellow out and not worry too much about the short term, basically.
Tom or David, do you have any thoughts on when to sell?
None of us probably sell very frequently. So I think my only quick meta thought is it's okay to sell. Where are you putting the money? Because that's really, it's not so much about a binary decision to buy or sell across each of the stocks in your portfolio. I have a more holistic view where I look at, let's say, the 20 stocks in a portfolio, and I say basically, is that where I want my money right now going forward? Those 20 stocks, is that the best articulation of where I think the future's headed with my money? And if I can't answer yes to that, or there's a 21st one that I actually do like more than this one that I keep holding on to, hoping it'll get back to even, then I would be the first to say you should sell that one and optimize forward. So again, think about the future, not the past. Think about the whole thing, not one stock. And yeah.
I'll just, oh, go ahead.
Please.
Sorry. I just want to add that as I was rambling about management, which is one of the major things I look at, it's the original thesis. If that has changed, then I'm likely going to at least strongly consider, but it's never a knee-jerk for me. I don't just sell rashly, which a lot of people do.
Do you have a specific example of when that's happened? Sorry.
Of which kind?
When management, that thesis changed for you?
I wish I hadn't done this in my real money portfolio. It's been several years, but I had invested in First Solar. This is one of those examples of something I wish hadn't happened, which was the stock went down, and unfortunately I saw some things that made me question management and question the future for that company. So I sold it, and I'm pretty sure that was a mistake at this point because it has just completely, it's recovered and more, and so I need to look at it again, basically. But I think that's hopefully something that happens to everyone.
We all make mistakes.
Every once in a while.
That's an important lesson for all of us here. It's scary to start investing because you're worried that you're going to fail, you're going to make a mistake. Everyone makes mistakes, and you learn from them and move on. And hopefully make those mistakes early. Make them early.
I'll just say we went back and did research on how well we sell as a company across all of our advisors, and we have delivered results that we're all very pleased with over the 20-year history of our company. Of course, we aim to do better over the next 20 years, but what we found is that we're not very good at selling. And one of the reasons I think we're not very good at selling is that we typically sell after the bad news has hit. It's natural, and that's when the price has fallen. And so if I were going to sell, I would be trying to look for problems before they showed up, which is difficult. And so I think Alice is right that in general, mathematically, the worst thing that can happen to you is that you miss a huge winner by selling too soon. If you hold a stock that goes to zero, you lose 100%. That hurts, believe me. I'm sure many of you have had that experience. Painful. But in a diversified portfolio, you can absorb that. However, if you're me and you sell Dell Computer, which I know has not had a great history in the last couple years, but it was one of the greatest stocks in American history from the early 1990s on. I bought the stock in 1995. It rose 25% a year. I ran my numbers. I was very quantitative then, and I decided that it was overvalued, so I sold. 25% a year, who's going to complain? The stock fell most of the way back down to the price at which I had originally purchased it. Let's just say that I bought it at 20 for simplicity, and it rose to 25. And I said, let's get out here. And it went from 25 down to 21. I felt validated, waiting for that $20 price for my opportunity to repurchase it again and just keep riding it up and down maybe. But it never made it to 20, and then it rose 40 times in value. 40 times in value is a lot more than a 100% loss. I'd much rather train ourselves to find great companies that we want to hold for years and decades and allow that some of them are going to go bankrupt or they're just going to underperform and we're going to be disappointed than to sit around worrying and trying to follow the prices from one day or week to the next thinking that we can pick them successfully because the data shows that we can't.
All right, Lou, this one's for you. There is a lot of hype about women being great investors. I wouldn't call it hype. I would call it science. Again, it's science. There's a lot of hype about women being great investors, Lou, but what can women learn from men to become an even better investor? I actually really like this question, so sorry to tease you about the hype.
Rick submitted.
Don't blame Rick. No, this is a really, really great question, and Rebecca touched on this a little bit in her talk. That, as I said, men tend to be overconfident. women, we tend to suffer from a lack of confidence when it comes to investing. We feel like we don't know enough. We feel like we need to keep researching, and those are good things. Those things can work for us because that means we're not investing in companies that we don't fully know and that we fully understand, but they can also paralyze us and make us not take action. I think one thing that men do, I think they do too much of it, as the studies show, but they take action at least. They are setting up brokerage accounts. They are buying stocks. They are thinking about it. One thing that we can learn from them is to take those first steps. Now, I'm certainly not suggesting we become day traders or that we start trading that much, but I think that's definitely one thing that women can take from men is just get in there. I mean, Deanna mentioned it earlier, Rebecca mentioned it. Even if it's just you buy your first stock, and I think this is a David Gardner concept too, you buy one stock, one thing, and you learn every single thing you can about it. Say it's Netflix, whatever, Chipotle. I mean, we could go down the list of the great Fool stocks throughout history here, but you learn every single thing you can about it, and that does help build your confidence that you understand. You're reading all the 10Qs, you're reading the 10K, you're reading the transcripts, you're learning about management, learning about the competition, and that can really help you. But you can't do those things if you don't first take that step of setting up a brokerage account and making a trade after ensuring that you have an emergency fund and your credit card debt is paid off and you're investing for the long term. But I would say taking action is one thing that women can learn to do better from men.
I have another to add, which is women tend to play it too safe in their asset allocation. And the reality, you've all seen this, we live longer, yes. We're out of the workforce, possibly raising children, so that means our money is not necessarily, we're not amassing salary and putting it away and so, stocking it away for Social Security. So playing it too safe is also a trait that commonly sets women behind. So I don't recommend this, but I was recently looking at my investments within the 401k and outside of my 401k, and I'm like a 28-year-old guy in the 401k. I'm like all in, let's go for growth. And outside with my money, my personal money that I've put aside that's not taken directly out of my paycheck, I find myself being very conservative and, in fact, overly conservative, given that I'm going to live forever. So, that is one other thing, to reevaluate your risk tolerance and also make sure that you are not undercutting the potential your money has to grow over the long term.
All right, Deanna, I'm going to stick with you just because you mentioned 401k.
Oh.
Susan wants to know, I've maxed out my contribution to my 401k. What next? By the way, I'm currently unemployed, but yay, emergency fund. Yay, you, Susan, whoever you are.
Yay, Susan. So great, you've maxed out that retirement fund that's available to you. If you're unemployed, you can maybe now is the time to actually invest in your future, in your potential. Maybe it's taking classes or getting an education in order to land a job. Like we said in the beginning, an investment is not just something that is not just buying a stock. It can be in something that improves the quality of your life now, or improves the quality of your life in the future, meaning your earning potential. And that is actually why student loan debt we talk about very differently than we do credit card debt, because student loan debt, although it's a problem in this country, it is something that you're amassing so that you can be better qualified for higher paying jobs. So I would start looking at investments in yourself and in your future.
All right, David, I've got a question for you about first movers. There have been a lot of first movers that have not succeeded, like Polaroid, Xerox, and others. How do you analyze first movers to determine the ones that will, in fact, make it?
So first mover is a phrase just given to very innovative companies that get out there and do something new, and they're first. And so if you think about Amazon.com is a great example that we know today, or iOmega, a stock that I also owned along with Rebecca and her husband, which was a first mover but isn't around today, at least in that same successful way. So I think that if you're looking at, let's say, two quick factors that you want to look for to find the better first movers, the first would be, I like to look right at the founder, and I like to know who is my entrepreneur, who's my visionary, my team, because really, underneath the brand names, the products, the services, the financial statements, and everything else, it's you and me. It's the people. And I had a great opportunity. Tom and I were at a conference The only time I ever met Steve Jobs was in the late 1990s, and he gave an incredible speech. At the time, he was the CEO of Pixar and Apple. And people were like, Steve, you are CEO of Pixar and Apple, same time. And we hear that, we Wall Street analysts hear that you spend 1 day out of every 5, not even at either job. You're just sitting in a conference room interviewing people for the companies that you're CEO of. You're just doing interviews, like low-level position, kind of how can you do that? And he said, in my experience, most people think that someone who's really good is about 5 times better than someone who's average. But he said, in my experience, somebody who's great is actually about 60 times better than somebody who's average. That's why I spend 1 day out of every 5 assessing the talent that's coming into my companies. So that's just a bet. That's just a number. That's a faith, or that's all right brain operating right there. He picked that number out of the air. But if that's how you think, and you can think the opposite of that and play that tune and live that and probably succeed too. So there's not just one way to success, how you think about business. That's part of the beauty of business. There are so many different first movers with so many different kinds of theories about the world, products or services or approaches that they take. But the ones that have real thinkers, real visionaries, people who can get out there and do it and make stuff happen, you love those people. Love those people at our company, and I love those people when I'm buying first movers. And the second factor, which I'll be quicker with, is this a company that is having real impact on real lives? I don't like first movers that are development stage, that have done cold fusion and are on the pink sheets. So I don't like the hope and a dream kind of company. I love any great stock that we've ever bought, or that at least that I've ever bought, usually had already doubled before I ever bought the stock. And even before it doubled on the public markets, it had to get to the public markets, which means it probably went up 100 times in value from a tiny private company just to even get there. So ask yourself, what kinds of people and what kind of impact in the world are those kinds of companies having? And the answer is, those are the good first movers, most of them. Caveat, final thing, 6 out of 10 we get right. 4 out of 10 stocks come as you've heard tonight. We will be wrong about. You will be wrong about. We will own them together, and they will underperform. And we have to be at peace with that. We have to say, that's great. It's just like being a great free throw shooter in basketball. You're going to miss 2 out of 10, but you're still really good. But you're going to miss 2 out of 10, so don't load it all up on one of those shots.
All right. I hate to do this to you guys, but we're going to do a lightning round.
Great.
And
Love
I
that.
may throw it at the wrong. I don't know. Do you guys just want to take a question, or do you want me to assign them to people?
Random.
Random? Yeah? Are you ready?
Define lightning. 1 word? 1 sentence?
1 sentence.
1 sentence.
One sentence.
Sorry. We have I want to try to get to, or haiku, please.
1 sentence.
Can you do a sestina, and then we'll actually make it really long. All right, Lou, this one's for you. Ready? Why does it make financial sense to buy stock in a company like Berkshire Hathaway, which never intends to pay a dividend but just continues to invest all the profits back in the business?
Because you're not smarter than Warren Buffett.
There you go. Dayana, can you tailor some advice for college students?
Yes.
1 sentence.
Oh,
Thank you. No.
You may use semicolons.
all right. And a few long dashes. Live like a starving college student for at least 5 years after you graduate, and put all of the extra money that you earn into investments. You're welcome.
All right, Tom, Jim Cramer refers to Twitter as a cult stock. What do you think?
I haven't looked at it closely enough, but obviously, in a way, as David said, it's an incredible business to have gotten to where it is. But I'm more interested in Facebook.
There you go.
Can I just also supplement that answer? I have
There
my-
goes the lightning.
No, this is even more
It's just
lightning.
a gentle rain now.
Ready? So can you just reread the question?
Jim Cramer thinks it's a cult stock. What do you think?
Who?
There you go.
That's better than my answer. More lightning light, too.
Okay. Alice, how do you keep your cool when the market was dropping in 2009? Or in general, how do you keep your cool?
Emotional detachment that is a little bit creepy.
Prescription drugs.
All right, Tom, what is today's The View recommendation? That's the one we're closing on.
I guess what we're saying is that it's got to go up 15 times in value in the next 15 years.
Or drop 30%.
I'm going to pass the lightning to my brother.
The Container Store.
All right, here we go. All right, well, that concludes our panel. Everyone can leave except Tom. So, thank you, everyone.